How do you actually record journal entries? We'll talk about that in this video. Hi, my name is Katherine. I'm your accounting tutor, and I help accounting majors through graduation and beyond. I've made some example transactions for us to work through today. They're listed up here. In order to make these journal entries, we're going to be using the guides over here. That will help us go through it step by step and hopefully not get so overwhelmed. We'll start with the first one. Jane opened a business providing bookkeeping services account on me. There's not a transaction here, so nothing to record, just a note. Okay, next one. On 1/1/24, Jane contributed $1,000 to the business. So we'll start by just putting in the date, 1/1/24, and we'll start over here. So without worrying about the debits and credits and all of the amounts, just what accounts are we using? In this case, it's going to be cash because Jane contributed it to the business. And also it's going to be owner contribution. As we talked about in the previous video, an owner contributing to the business, owner contribution, it's an equity account. And then we pick the one that feels easiest. To me, cash always feels easiest, so we'll start there. Is that account going up or down? Now, a lot of students can get mixed up when they're thinking about this, and they tend to think about it from Jane's perspective and not from the perspective of the business. And it's really important that you just stay focused and know that we're working on the financials of the business. So from the perspective of the business account on me, the cash is going up by $1,000. Is that account an asset, liability, or equity? Well, cash is an asset, and assets go up with a debit. So we'll write that down. So we have our account, which is cash, and we'll debit $1,000. Put that in the journal entry, and then we go back to 2 and we do the different one. So the next account that we're dealing with is owner contributions. Owner contribution is going up because Jane is contributing to the business. It's an equity account, as we previously discussed. Equity goes up with a credit, so it's going to be a credit. I'll do a little indent. Owner contributions of $1,000, and our debits equal our credits. We're good to go to the next one. Next one, Jane spent $500 to buy a computer on January 5th, 2024. So we put the date in, and again, we start, what accounts are we using? Well, she spent $500, so that's cash, to buy a computer, so that's the account of computer. The one that feels easiest is always going to be cash for me if it's there. Is cash going up or down? Cash is going down because we're using it to buy a computer. Cash is an asset, and assets go down with a credit. So I'm going to skip a line, indent, and put our cash down here for the $500. Circle back, we have the account of computer. That's an asset. Assets go, and is it going up or down? Computer is going up because we're buying it. We didn't have it before, we have it now. Number of computers we have is going up. The value of the computer is going up. Computer goes up. Computer is an asset, goes up with a debit. Debits equal our credits. We're good to move on. Next, she put an ad in her local newspaper for $100 on credit on January 6th. So what are our 2 accounts? She put an ad in her local newspaper. That's an advertising expense. And then she did it on credit. So that's going to be one of the accounts. A lot of students can get mixed up with accounts payable and accounts receivable. My best advice is to just not overthink it. If it's money that you have to pay, it's accounts payable. If it's money that you have to receive, it's accounts receivable. So in this case, she puts an ad on credit. It's someone that we have to pay for putting the ad in the paper. And so since we have to pay it, it's accounts payable. We'll start with that one. Accounts payable is increasing because accounts payable fundamentally is a long list of people we owe money to, and that list just got a little longer, so it's going up. Is accounts payable asset, liability, equity? It's a liability because we owe someone else money. Liabilities go up with a credit, so I'm going to put it here. For $100. And like we said, it's an advertising expense. for the same $100. Oh, and I didn't go through it. The good thing is when there's only two accounts, sometimes you can just, once you figure one thing out, then the other thing is the other thing, but I'll go through and walk through it with you. Advertising expense is going up because expenses and revenues are, again, just lists of all the money we've spent, all the money we've earned. So the advertising expense is going up. Expense is, in a roundabout way, an equity account. As we talked about in the previous video, equity gets impacted by both owner contributions and retained earnings, which is impacted by net income. And so anything that increases net income also increases equity, and anything that decreases net income also decreases equity. So advertising expense will decrease net income, so it will decrease equity. And so our equity account here is going down, and equity goes down with a debit, so that's why we're debiting it for $100. Next question. A client paid her $75 cash for bookkeeping services on 1/10. So we put our date, 1/10. Okay. A client paid cash for bookkeeping services. So what accounts are we going to be using? There's cash, and then it's going to be service revenue for her bookkeeping services. Pick the one that feels easiest. It's cash. Cash is going up because someone's paying us. Cash is an asset account, and assets go up with a debit. So we'll write that down. Cash of $75. Okay. And the other one is the service revenue. So service revenue is going up. We're providing a service for someone, they're paying us. Service revenue is an equity account because it increases net income. And equity accounts go up with a credit, so I'll put it here. Service revenue of $75. Next question. Jane provided bookkeeping services to a client for $100 on account on 1/12. So we'll put our 1/12. And now here she's providing bookkeeping services on account. So it's not going to be cash, it's going to be accounts receivable. And as before, it'll be service revenue. So accounts receivable and service revenue. We'll start with accounts receivable. It's going up. Someone's owing us money. It's increasing. Accounts receivable is an asset account. Assets go up with a debit. So we put that here for $100. And again, it's service revenue for the bookkeeping services. Revenue is an equity account. It's going up. Equity goes up with a credit, just like last time. Okay. Then on 1/17, we received payment in full from the client on 1/12. So on January 12th, we performed services for them, and then on January 17th, they paid us. So our two accounts are going to be cash and accounts receivable. Cash because they're physically paying us cash, and accounts receivable because the reason they're paying us cash is because they owed us money. So in this case, cash is going up. It's an asset. Assets go up with a debit. And it's from the client on 1/12. So on 1/12, it looks like they owed us $100, so that'll be $100. The other account is accounts receivable. Now, accounts receivable is going down because remember, it's just a long list of people who owe us money. Because they've repaid us, that list is getting smaller, so the account is going down. Accounts receivable is an asset. It benefits the business to have people owe us money. Assets go down with a credit, so we put it here. And then on January 20th, we repaid the newspaper in full. So remember, we paid the newspaper with accounts payable. And so the two accounts that we're going to use are cash and accounts payable because we're paying them. Cash always feels easiest. Cash is going down in this case, again, because we're paying them out the cash that we had owed them. Cash is an asset. Assets go down with a credit. So we'll put it here. 4, we paid the newspaper. So the newspaper was up on 1/6, $100. And our other account is accounts payable. It's going down because we don't owe them money anymore. So the list of people we owe money to goes down. Accounts payable is a liability, and liabilities go down with a debit. So we put that here. And then on 1/30, we took out a loan from the bank for an additional $1,000. So the two accounts that we're working with here is going to be cash, because we took out a loan there, and what they gave us was money. It doesn't specifically say that, but if it doesn't specifically say anything else, you can assume it's cash. Took out a loan, so that's going to be notes payable. That's what we call those longer term loans that we get from banks. What feels easiest is cash. Cash is going up. Cash is an asset. Assets go up with a debit. So we put that in for $1,000. And the other account is our note payable due to the bank. Note payable is going up, again, because we owe them more money. Notes payable is a liability, and liabilities go up with a credit. So we put it in here. That's all there is to it. I hope you better understand the process, seeing the steps that we go through and seeing it all written down over there on the side. If you're having trouble figuring out what accounts to use, I made a note over here. If you're missing something, what students tend to miss is an expense, a revenue, or cash. So if you find yourself stuck, ask yourself, am I missing an expense, a revenue, cash? If you're selling a long-term asset, like a building or a piece of machinery, there could also be a gain or loss involved. We didn't deal with that in this set of transactions, but sometimes it does come up, and it's another one that students sometimes can't think of, so I wanted to go ahead and list it there. I hope that was helpful. If you want more resources, check the description, and I'll see you in the next video. Thanks. Bye.